Okay, welcome to the quarterly call from Cirrus. I'm Satya Pradhuman, Director of Research. And in the quarterly call, we typically walk through how we're framing the current environment. We'll talk a little bit about a few key themes, things to look out for, indicators that we think are very relevant in this period. Before I jump into it, one of the things I wanted to flag for you is the new Cirrus website, as you're seeing it on the panel here. It allows you not only to pull up our research, but now you're able to really get access to the last 15 plus years worth of the research archives. This has been built out fairly well by some of the developers. In addition to that, in the spirit of making things easier, we've also added a few other media components to the research panels. Basically, you now have summary access in video form on most of the key reports. We've also launched some interview series webinars that really delve into various topics. And in addition, we also now have a podcast launched that you can get through your usual sources, such as Apple and so on. But yeah, let's dig into it. As we've opened this call, we are formally in a bear market. Whether you're looking at the S&P, which is down more than 20%, if you're looking at NASDAQ, which is down more than 35%, depending on which hour. Importantly, today, the report on the CPI, it topped expectations, and we continue to struggle with what the Fed's going to do. In short, we've all become Fed watchers. In addition to this, we've moved the 10-year Treasury is now moving, ebbing and flowing around the 4% handle, not the 1, not the 2, not the 3% handle. So, you know, if we were wondering if you're in a different frame of markets, clearly these components are telling us we're in a different place. In terms of framing the markets, you know, we've been, I guess we've all been playing defense now for the past year and a half. A couple of the things that drive this behavior, and that also tells us we're probably not done playing defense, is at the heart of it, the peaking of the profit cycle. It's clear to us that basically what you've got is the sharp rebound in the global reopening has run its course. Some of that is starting to roll over. But in addition to that, clearly, a ton of the liquidity that was added in the last few years, that is now being slowly but surely siphoned out of the system. And that basically calls for a very different market posture. And so to some degree, these are elements, believe it or not, that we have a handle on, that we can address the market the portfolio. On the other hand, there are factors here that are well beyond anyone's control and visibility. Really at the top of the list is the inflation surprise. I mean, to some degree, I think we're all aware there was going to be a supply chain issue coming out of the pandemic. And at the same time, I don't think any of us understood the degree to which this thing will run, and also to the odd sources and changes that we witness. In addition to that, though, probably the ultimate curveball is also being the commodity risks that have surfaced, that I don't think anybody was forecasting an ongoing war in the Ukraine as it struck the system. And so that has some huge bearings on some of the components in the equity market. If you look at your returns year to date, I think, broadly speaking, only one sector is up for the year, and that's energy. So this is an area that this basically tells us how challenging performing well in this market has been. I want to walk through this idea, though, of a barbell posture, because we think that a lot of the things I've just flagged there, the visible risks that we've had to deal with, which is the peaking of the profit cycle and the fact that credit markets are going to be tougher just because of the simple Fed movement. Those things can, I think, be handled by the barbell posture, and I think it's done well. The idea is that to to some degree, you're going to focus on higher quality. If the profit cycle is peaking, then by definition, you've got to be there. We do know that the supply chain issues, the commodity moves also create additional margin pressures. Clearly, these are things that are telling us that we want firms with better margins, more visibility on earnings, et cetera. So this has been a sort of standby variable that has mattered. The problem with the word quality is the word quality, which is, it is probably the most abused word in our industry of investing. And then countering this is this idea that we kind of saw, I think a lot of us understood that there was a breakdown in innovation multiples. We saw it coming. I think, the question was, which year was it going to kick off? And when it did, you just didn't know when it was going to stop. But the fact is, if you've got the Fed really tightening the screws on the system, by definition, the highest multiples in the market are going to come down. So that has been steadily coming down. So that was the downside risk that we needed to protect on, which was a respect for valuations. This is something that we hadn't been around, that we haven't really focused on for a while, but along comes the Fed, and therefore we've got to deal with a valuation discipline. In addition to that, another way to potentially amplify this backdrop is to also consider commodity groups. We call them the IMEs, industrials, materials, energy. I'll get back to this a little bit later, but this idea of a barbell strategy, it is not a one size fits all. Part of it is that some of the risks in the system, I think we can identify some of the risks in the system. So for instance, how far does the inflation scare and risk run? We don't know that. However, some of the elements in this barbell structure does tell us that, hey, if you're paying attention to valuations, you're probably going to get hit less. And so to some degree, this framework allows us to navigate and manage some of the risks we can isolate. And yet in some ways, it does protect us really from the sort of unknown components, that the moving parts that are also like flying around right now. So, at the end of the day, one of the things that has really made this environment a little bit tougher is this idea of interpreting the data with inflation. And we've written a little bit about this, which is to be very wary of the way we interpret the data, that we all have these inherent bias, and you've got to be aware of that, especially as an investor. There's plenty of research that addresses this. But in this current chapter, think about this idea that if you're running money and you're running a growth fund, are you more likely to be calling for a recession? So in other words, the moment you get some weak data, are you racing to a recession, and why? Well, after all, if you're running a growth portfolio, at the heart of that is this idea of a constructive interest rate backdrop. If you go into a recession, if we accept a recession, rates rally, higher multiples get a breather. Okay, and then counter to this, if you're a value investor, is your bias for your book? If you were to have higher rates and some inflation scare, nobody truly wants inflation. But if you were to have these chapters coming at you, and you do have enough data that's telling us that's the case, by definition, innovation multiples break down, the growth story goes away, valuations matter, your discipline works. And so to some degree, I do caution you on this idea of like the data is really sloppy. None of us have had practice in managing economic data coming out of a pandemic. At least I don't think anybody that's practicing in the markets can handle this. And so we're all learning. And so there are curveballs to this chapter, but at the heart of this, there's some obvious elements. But the bottom line, though, of what we're getting at here is this is an earnings-driven market, and the sobering part of this is that earnings-driven markets are lower return markets. And so, I guess cynically think of it this way: we do not have an external force chasing investors to buy risk assets, at least not for now. And so this is at the heart of what's so challenging in this environment, to see all this red on the tape. So what we're going to do in this conference call is really walk through how the Cirrus team sees and tracks the current level of risk, and how we navigate to close strong in 22 and entering 23 in a better place. Today, I hope to walk through how we're playing defense, and at the same time, can we add some offense? After all, the market's down 20, 30%, depending on which pocket you're measuring. All righty, so let's get started. Part of the title of our quarterly outlook, it had a phrase in there, and I guess I should defend it a little bit. It said risk capital at risk. And in that phrase, what we're really trying to get at is a simple thought here, which is, if the cost of capital is going up, then growth is going to slow, and you're going to have industries and segments that really get punished depending on how dependent on capital they are. And so one of the idea of risk capital, though, is that, let me define that for you. I borrowed this a little bit from one of my former professors at NYU, Professor Damodaran, and his reference to risk capital looks at VC funding, credit spreads, and IPO trends. And these are elements, if you're in the small mid-cap space, heck, if you're in active management, you should care, right? Because these are it's basically cost of capital that drives growth. And so 2 out of these 3 variables, though, they are really driven by pricing in the public markets. So I don't think we have to look too hard to figure out if the cost of capital is going up. I think we understand that with fixed income, but why is the equity market getting hit so much harder than you would think? And a lot of that has to do with the fact that multiples are sharply down. It is also sending a signal to other parts of the capital markets about pricing assets. And so the question on credit spreads, that's fairly easy. When we look at credit spreads across the US through various regions, they're all behaving in a monotonic fashion, which is that we've seen credit spreads back up from basically 30-year lows, right? You were looking at spreads in the 300 basis points above Treasury handle. We're now, north of 400, 500, depending on where we're quoting this. And so this is a really fundamental issue on the cost of capital and the risks that we see. At the end of the day, though, what we're now thinking about is really what's the fallout there. So when we've got the markets pulling back sharply, we've also got credit spreads widening. When we look at the IPO trends, some of our other work shows that you're effectively, the IPO market is really stalled out. And that makes complete sense when you think about the managers of these funds, the private equity funds. They're looking at the public markets to see what the multiples look like. So if multiples are high, it's time to issue. And if multiples are low or falling, clearly you're not going to put your paper out in that marketplace. So what we can clearly see is that just about every form of risk capital is tightening to some degree. You've got a full-blown credit crunch in the VC space. So that's one of the elements that we are tracking that forces this idea that the innovation shares that have really taken a beating, the fundamentals of that backdrop is really being stressed here. And so as people look to bottom fish, we really think that's a challenge in the system. To some degree, I really like how the comparisons are shaping up. And back in late 2020, we put out some work on innovation shares, and we started, really look at various proxies. And one of the favorites we picked out was the ARK, one of the ARK innovation funds. And what we've noticed is that during the period of the easing prior to the pandemic, these multiples for that type of product were somewhere between 3.5 times EV to sales to about 6 times EV to sales. As the pandemic ensued, and as the Fed began to really add liquidity to the system, these multiples climbed north of 8, north of 10, all the way up to about It peaked, I believe, about a year ago, year and a half ago, at about 15, 16 times. Since then, we've seen the correction in these shares, but importantly, what we're seeing is the multiples have come back all the way below that 4 handle, which is so important. So, in other words, our point is that the downside risk that we have been concerned with, I am less concerned about this piece of the market. In fact, this will tie into why the small cap story just is getting a lot more interesting, and maybe small cap growth is the space to watch here. But yeah, I mean, at the end of the day, the innovation risk is front and center. I think we've really dealt with it. The market's certainly pricing it in. The concern that we've had, though, was in the spring, where we had innovation shares that have been breaking down for over a year. Finally, we started to see that contagion to some mega cap tech and extended FANG related names. So we did start to see that track. And I do think, we've got to think about this in terms of behavior, which is we're likely as individuals, if we're nervous, we're going to sell the things that are riskiest in our portfolio. At the same time, we are probably going to hold on to our sacred cows. And if ever there were sacred cows in the market, I think the FANG, the extended FANG labels, those names certainly fit the bill. And so it's taken a while for the market to run through this process. We are, it is underway. If we look at valuations for the system and for the technology sector, we've seen some real adjustments, most notably in the smaller cap arena, but nonetheless across the board. I do think, though, that if we continue to remain nervous about what the Fed is likely to do with rates, these shares, I would caution you to think of them as opportunities. To some degree, they become dead money. And this stuff happens pretty much in any bear market, that what was leadership before somehow or another goes out of favor for some time. And so that is one element that we've got to think about. So in other words, we're probably less worried about innovation, and at the same time, risk capital remains at risk. So bottom fishing in this space, I would be very, very selective. Another area I focused on was really the earnings backdrop, and to some degree, we don't need to get too technical about the profit cycle. When you look at most measures, whether it's earnings, we love to look at top line growth or sales growth. Those numbers, thanks to coming out of the pandemic in the last 18 months or so, we've seen those numbers snap back sharply. Part of that is just math. You divide anything by 0, you'll get infinity. So the comparisons in top line growth has really climbed off the scale. Globally, we're seeing this. The most dramatic pullbacks we've seen is really Asia, and second to follow is Europe. Europe is likely to have some added burdens as we look forward here. I think everyone's familiar with the phrase "winter is coming." And so to some degree, I do think that given the commodity risks that they face, and we all face, I guess, Europe is probably front and center. So in other words, as the profit cycle slows, we're probably likely to see the US be more resilient, but nonetheless, we're at the upper end of the comparisons, and it's just beginning to roll over. And so that is something that we really got to, really think about. Part two to this is really where our expectations, and we model earnings expectations, the forward year estimates, they have begun to roll over. It's clear that analysts are paying attention, and they've really pulled estimates back. That said, if we are going to tumble into a recession, you pick your flavor. At the end of the day, the break in estimates have not gotten there. And so we believe the confluence of things going on here, the fallout, the second order effects of what the Fed's doing, for instance, a much stronger dollar, those elements now begin to kick in. And so to some degree, we are bracing for this coming quarter's earnings. We do think the smarter CFOs are likely to put out as much news as they can and break expectations, because everybody's going to do it. And so it's going to be an interesting period. I'm hopeful that we are closer to a much more steadier market. I think price action already sort of suggests that. In addition to that, when we think about the currency, as I said before, the fallout of the stronger dollar is fairly severe. We've done some work on this. I do have to caution you that the data on foreign exposure is very, very loose. But if we measure the baskets in simple top of index, bottom of index, what you'll see is that, clearly, if we consider the dollar euro, the dollar pound relationships, the dollar has strengthened sharply in the past year. To no surprise, highly foreign exposed firms have corrected beyond what the market weakness is. And so the moral of the story is that the earnings risk that the market's already begun to price in is just getting started. These things do not reverse overnight. And so I suspect part of the earnings puzzle is going to be driven by the smarter CFOs sort of thinking through how, what's the duration of that hit to the dollar and therefore their sales. So at the end of the day, the U.S. currency may be the most important thing to watch. We're all busy watching the consumer as a hint to whether the Fed will make a move. I don't know if that's going to be as good an indicator as the strong dollar. And here's why. We are starting out this tightening cycle with record low unemployment. So what that means is it gives the Fed more of a runway to do what they think they need to do. However, if the dollar continues to punish other currencies, the fallout effects from that could be massive. And I think having grown up in the last few decades with the global recession and the way markets can be tied together in the bond markets, I think they're more than well equipped to watch what the dollar is doing. So to some degree, there may be a hint of good news in given how strong the dollar has moved. While I think the Fed may have ignored what was going on in Asia because they are dollar tied, I don't think you could ignore Europe. And so I'm a bit more optimistic, I think, in terms of what's going on there. So yeah, in other words, this is going to remain a challenge to the system. So the question is, how do we play defense? And a couple of things here. One, just more on the immediate front. And I brought up the subject of earnings and the earnings reporting season. One of the things we tend to focus on are these torpedo tools. This is work we've borrowed from Bob Hagan's paper back in the 90s. Fairly straightforward. The idea is that look for where the expectations are highest among stocks. They tend to probably be some of the riskier. In that paper, they walked through adjusting the expectations for valuations, and you seem to do better. We did something slightly different here, which was we looked at the earnings visibility of a firm and at the same time, the conviction in those forecasts. And so what we're looking for is really where are firms' expectations most aggressive and at the same time, a ton of conviction. In other words, not only does the analyst raise the forecast, but they're sure. Those are names in this kind of environment, given what we've outlined, are going to be the names you've got to debate internally. It's not as simple as, oh, because it's in this list, let's sell it. But the point of it is that if you or your analyst loves this company and they're in this list, the question should be, do you know everybody else likes it? And what do we do if they disappoint? Do we buy more or do we potentially thin out exposure before this number comes out? And so we've been able to use this in terms of playing defense, especially if you're concerned about the earnings season. At the same time, you can also consider what a fallen angel is. Like, in other words, with this sort of a fallout market, where the firms where expectations have really collapsed and everybody's sure they're awful. And so to some degree, this framework, which we deliver the data for clients on request, this framework, I think, is useful, probably more useful than usual, given the current backdrop. In terms of this word quality, and I wanted to get back to it, at the heart of it is this idea that, we are, it is obvious that we want to look at more visibility, better balance sheet, better margins, or at least less risk on margins. The problem is, the word quality is very loose, especially in our business. And but if we think about some basic measures, what we can basically see, I think irrespective of the measures we use, what we can see is that over the last year or so, higher quality baskets have outperformed nicely. And so, to some degree, this makes sense given what we saw going into the pandemic, that in the pandemic where quality should have worked, what we ended up trading was Peloton and Zoom. And so quality stocks took a real beating in a period where they should have worked. In addition to that, you went headlong from there into a reopening trade, which was deep cyclicals. And again, quality took a header. And so what we've seen in the last 12, 15 months or so is a massive rebound in higher quality. I got to say, some of the numbers are overstated if you're looking at it in spread terms, just because it's really been low quality stocks that have been hit very hard. It's been tough to find places to hide out, but you've lost less ground. And I guess that's a good thing. If this is a game of relative performance, it's going to matter. At the end of the day, we do think when you look at higher quality, you've seen a hiccup in performance in the last quarter, and we've echoed it in some of our reports. I would argue that this is the pause that refreshes, just because of everything we've outlined, that the question is, how far could quality run? And what we can say is that we do see more headwinds on the profitability side. We are concerned really about the credit markets, because that's still a random event. And so at the same time, what you could also think about is really what is the price of quality? And for the most part, when we look at the multiples on the quality baskets, they've sort of come back from 20-year lows about a year and a half ago. And they've sort of stabilized to sort of longer term averages, depending on whether you're looking at large, mid, or small. And so moral of the story is that I think the quality theme is back. And you did have this pause in the past quarter. I think a lot of that was some bottom fishing, because we were very busy calling for a recession. And at the same time, you did have yourself a move in the commodity sector, which will subsume the quality ranks if energy is outperforming. But when you separate them out by sectors, it's clear that you've had a very, very dominant quality move in the last 12, 18 months. I do not think this is going to go away. A couple of themes that I want to really jump to is this idea on the size premium and the style premium. Both of these are areas that I think really matter. What a lot of our work has done, as stated in the last year and a half, has been to go to large cap. The large cap bias was there for a lot of the reasons I've just walked through. At the same time, though, if you fast forward, given the break in innovation shares and how much the Russell had broken down from about a year and a half ago, what we're starting to see is a very different world where smaller firms, the comparisons, we know that they're cheap, right? And they are pricing in a lot of the challenges. The curveball, though, is that if we were to break growth stocks further, I would argue that small cap growth is the place to watch, because their multiples have truly fallen out of bed. And so that's actually what's driving the small cap comparisons, right? So the small cap market is really sort of a two-headed beast. You've got some deep value situations, and you've got aggressive growth on the other end. And together, you get yourself the small cap market. But yeah, at the end of the day, I do think that the size premium, in our eyes, it just got a little more interesting, a little more constructive, because the market's done a great job pricing in some of these concerns we flagged. A fallout to this is also the growth versus value debate. I won't go into it in much detail, just because we've published a lot on it. The heart of this, take a look at the signals report, by the way, for monthly updates on our oscillators. But that indicator had made a nice move into growth from value about a year and a half ago. It went to a pretty overweight growth position in the last 6-12 months. And in the last few months, it has begun to roll over and gone much more neutral. And I think this sort of qualifies a little bit of what we are saying about the size premium. I think they are tied at the hips, and you can't really ignore one if you're talking about the other. So yeah, I think in short, the growth versus value debate, I don't think in the next 6-12 months becomes very interesting, because as much as you're no longer going to chase, speculative growth stocks, the reality is that if you're focused on quality, that's not your lowest multiple quadrant of the market. And so it does get a little choppy. I don't think the growth value debate is going to be interesting in terms of alpha. Um, so we've talked a little bit about the house view, playing defense, how to play defense. The other area I wanted to really talk a little bit about is how do we play offense in this environment? And a couple of things that I want to flag are really this recent report on CapEx, and I think it's a big deal. At the heart of the CapEx story is this idea that there is a trade-off, that when it comes to budgeting, there's only so much money in the till. And so if we are arguing that there's this phrase energy security has surfaced, the phrase infrastructure has surfaced, a lot of these things we've done some pretty serious work on. Those things are telling us that industrials CapEx is on the move. And guess what? If you're looking for the FANG stocks to bottom and then jump back in, think again. This is very much a 2002 to 2006 moment. In other words, if you were running money back then, what happened after the internet bubble sold off? Well, what happened was that we went and shifted the gears completely for the next several years, 4 or 5 years, into the industrial material energy space, or the IMEs, as I call it. We think that in the recent piece, we did a case study on exactly that area, that period. And I think it's very telling how different markets can be for extended periods, multi-years. And so in that report, we talked a lot about how the industrial spending started to reaccelerate back in 2002, 2003. And bear in mind, even though technology stocks had sold down, it's not that tech spending fell off a cliff. That's not really what we're saying. It's just that in terms of the CapEx budget, there's two parts to it. And as a CFO, you only have so much money to spend. So if you're focused on the cost of plant and equipment, maybe because of higher energy costs, it's possible that you're going to spend less on routers and Zoom. And so guess what was also similar? By chance, we did a massive tech buildup in 2000. That was a Y2K moment. In this instance, it was the pandemic moment. And the other part to this puzzle that's slightly different is this idea that, what caused the spending back in 2003 to 2005 or 8? A lot of that was China. As China continued to build out infrastructure and continue to spend, it drove the focus, the industrial spending focus. And when we look at the fallout on equity markets, as if you're an active manager, please go back to those days and see what was going on. And my message to active managers is be careful in thinking you know what a growth manager is. Growth investors also go anywhere they can to find growth. And if tech spending is no longer accelerating and you've got other pockets of the economy accelerating, guess what? They're going to find it. And so I sort of recall a period where if you go back to 2003, 2004, where growth managers were espousing the beauty of the technology behind oil service companies. And so again, this is a really big deal. I think that if you do get this sort of multi-year rotation underway, this idea of like dead cat bounces are here to stay instead of a more meaningful focus on growth areas. So, at the end of the day, that's one. Two, we've done some work on clean energy. This idea that if it's energy security, that buzz is going to also force sort of like other changes to the platform. We clearly have some dramatic shifts in the way we're looking at EVs and the like. These things, ironically, they call for basically more commodities, right? So mining, minerals, these things are now back on the menu. And so at the end of the day, we think this is an interesting area. The recent work we've done, we did some work on clean energy, and that focused on the material segment versus the components. What's curious is that the components, which are the highest, were the most speculative components, speculative group within the clean energy vertical, they've broken down sharply, just like every other innovation group, and yet some of the more materials driven companies have been on the move. So in a bear market, you're seeing certain commodity groups rise. Why I think this is important is to think about this. We're busy pricing in at the same time a global recession. The commodities groups are down. The raw commodities on some of these minings and metals are down. It may be very opportune if you look out ahead the next 2-3 years to figure out that, hey, at the end of the day, this is something that the spending patterns are likely to accelerate, not slow. So to really bring this together now, what I want to do is just sort of like frame this out a little bit more slowly, which is one, we've been playing defense for a while, and the barbell strategy has really helped us really navigate this environment, I think, pretty well. I don't think this is over. I think we're going to be stuck with the barbell a little longer than I'd like it. Markets are already down over 30%. We're still bracing for the credit market to continue to sort of back up some more. I'm hoping that we're wrong. And the question about inflation, that is a mystery to us. But if we are focused on valuations to some degree, that random factor becomes manageable, or at least we lose less than we could have. And so in terms of this lower multiple market, I do think we're here for longer than people realize. I do think the Fed is underway making their move, and the data probably could give them a longer runway than most people think. And so, yeah, I think this sort of barbell strategy makes sense. The other tool, an element that we talked about, is really think about the earnings season. How do you play defense with earnings? You certainly, basically build up a bulletproof sort of portfolio of names with regards to earnings risk. And then in terms of like how we put this to work in terms of the actual portfolios we design here, we build we have several blends of growth portfolios, and we have several value blends. They are skewed in terms of risks. So on one end of the world, we have aggressive growth portfolios for obvious reasons. And then on the other end, you have quality growth. So given everything I've said, clearly we're going to be in the right-hand side of that quadrant, which is the quality growth space. Somewhere in the middle is more GARP, which is more valuation sensitive. I think if we do see more of a commodity run, the GARP model will likely outperform the quality growth model. And then on the other end, there's deep value to the other extreme of quality value. By definition, I think we're in a quality value market. We don't have the confidence to chase commodities just because we're probably in a world where oil prices are higher for longer. Just because I think globally, everybody's looking at the dollar. And so at the end of the day, I think earnings visibility matters. Valuations will offer some protection if the rate risk is worse than we picture. So really, I think those are the critical takes from the work and the way we're framing the markets right now. For those of you who have tuned in late, we will be sending a replay of this, so you'll all have access to it. And again, please feel free to email us or call us with any questions or follow up. Some of the reports I went through in this call, the signals report, which is our macro signals indicator work every month. In addition to dispatch, which is really the primary driver of our quarterly outlook. And we also, I think, noted a few other items from some of the industry and factor notepads that we publish from time to time. So with that, thank you very much for joining us today.